I'm Pierre Daly, Managing Editor at AdvisorAnalyst.com. My co-hosts are Mike Philbrick and Rodrigo Gordillo, Principals at Resolve Asset Management SEZC. Our guest today is Wade Guenther, Partner at Wilshire Phoenix.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Wade, welcome to the show. It's great to have you.
Thanks, Pierre, for having me on. It's really excited to be here, and thank you.
Great to meet you, Wade. I don't think we've ever had the chance of meeting in person, so this is a bit of fun.
If it would be really great if you could tell us about the arc of your career, where you started in the industry. How you started in the industry, where you started, where that's taken you. You've actually had a very interesting career path that's been quite varied. So we thought we'd start with that.
Yeah, I started in the ETF industry, I want to say back in 2009 at BMO, just with their website and they only had about $2 billion in assets at the time. And now I think they're the number 2 ETF sponsor in Canada. I started there, and then I went over to Horizons ETFs, and I was the ETF analyst there. Worked with a really great cast there. I believe you're familiar with Steve Hawkins. He's out quite a bit, and he is a phenomenal guy. I learned so much from him, and he gave me an opportunity to move into the portfolio management division with working with the covered call funds and as an assistant portfolio manager to Eden Rahim. He was he was so excellent at the covered call strategies and running those strategies. And he is to this day one of my mentors. And he is just such a special person to me. Gave me all the opportunity that I wanted, and taught me so many things about options and the industry. It was just such a great opportunity. And then when he left the firm to start his own thing at Next Edge Capital, I was there from 2011 to 2000 and I guess the end of 2016 when I moved to New York. And then after that, I just became a portfolio manager, took over the covered calls space, and until they brought in Nick and Hans, and then we all worked together as a team. And from there, it was managing the leveraged and inverse leveraged funds, and doing that with the whole team there. And that team is so phenomenal, really great cast to work with. The operations are run so well. And I guess it's just a lot of credit to Steve and everybody who run that shop that really, really know that business so well. And, I'm just thankful for the opportunities they gave me, and now I'm here. So from there, I moved to the United States and worked at the.
How did they suck you out of the Canadian marketplace to get you to go play in the U.S.?
It wasn't them. It was actually my wife. She had a career opportunity there with her firm, and they moved her to the U.S. And I made this joke when I was leaving, and it's like, Steve, I love you, but I love my wife even more. So I guess I have to go, and that's how that went. And I went to the Horizons US office, and they just had a couple of funds there, and that business really, really struggled. And they ended up, I guess the parent company, which was Murray Asset, ended up purchasing Global X and rolling the 2 or 3 funds that Horizons had in the United States into Global X. And then after a certain amount of time, this opportunity came up that I really couldn't pass up. And I'm just really excited to be here and just start building a business from the ground up. And it's phenomenal to watch.
So it sounds like, you've had some pretty good luck in your run. BMO, the infancy of the ETF business there, and their management group really putting a shoulder into that. And then moving into Horizons, probably, I think BlackRock's probably number 1. And then you've got BMO, and then you've got Horizons. And certainly Horizons is up there as one of the, I think probably the largest independent sort of non-bank owned ETF provider, if not that, then very close to that. So you had a good experience in starting at companies when they were in their infancies and then growing them along. And so I understand that some of the products you have at, it's Wilshire Phoenix. Am I pronouncing that? I got that right? So Wilshire Phoenix is going to have some real asset sort of tone to it, if you will. And you've got some expertise in that area. So, I think it probably makes some sense. And as I was mentioning before, I saw the one article this morning, people are piling into the commodity trade, realizing that may have been a bit of a hole in their portfolio. Maybe not so much in Canada with the Canadian equity portfolio in Canada that helps hedge that a bit. But let's talk about that. Let's talk about the role of real assets in a portfolio, how they help hedge inflation and things like that. What are your thoughts there?
Yeah, we think real assets have a huge advantage in a portfolio. I mean, we just generally find that the diversification benefits are really hard to ignore, right? Like they're generally non-correlated with broad equity market returns. Things like real estate, for example, the similarities is that real estate tends to have long cycles, whether it's just positive returns or negative, but again, they're just non-correlated with broad equity markets. It's a good physical asset as a diversification enhancement to a portfolio. And we see gold as that in the same kind of class, like a physical asset, generally non-correlated returns with the broad equities over the long term. And it's considered a store of value and a safe haven in more tumultuous markets. So that's one of the reasons why we brought our gold product out to the market. It is the first ETF for us, but we just feel like that real asset or the innovation in the real asset space was really not there.
Right. And how do you, when you're talking to advisors and allocators, how are you helping them slot in real assets? Is there any guidance that you give, or especially given the context that we're in currently with sort of this shift from, largely a monetary policy and monetary largesse and away, shifting through COVID and having massive fiscal stimulus where, you actually have money hitting, the Joe Six-pack, the Main Street guy. So we have some of those inflationary impulses, some of that, supply side or demand pull side tactics are coming through because the money is actually getting to Joe Six-pack, I'll call it. But what are your thoughts there, and how are you seeing the macro landscape playing out for real assets in general?
Well, we think there's a really it's a great story for real assets right now, because especially in the US, and I'll just start there first, is that the federal government is making a really big push on infrastructure and economic growth. And, they're talking about, fiscal, probably tightening fairly soon, but in terms of like getting people back to work and that sort of thing, the big push is on infrastructure, and the spending on infrastructure is going to likely put a massive demand on real assets, the input materials. And on a global scale, we see this being very effective when, say, emerging economies are moving into more developed nations through the advancements of technology. Buildings are going to be either built or rebuilt with modern technology advances, again, which was going to require infrastructure enhancements and, again, more raw materials for these construction projects. And we're talking on a global scale. Could be a huge opportunity for people who are investing in real assets.
I know Rodrigo's got some good Peruvian stories on how that inflation manifests and growth manifests into some of the more developing areas of the world through these types of inflationary impulses or inflationary growth impulses globally, where you get, $1.9 trillion in stimulus package from Biden that is directed at, call it bridges and roads and ports and those types of things. A lot of the minerals and things like that reside in Latin America.
Yeah, certainly. It's interesting because there's so many facets to inflation. The one that you're describing, Wade, is one where there is actual money being used for productive purposes, where you're going to have infrastructure being built out and natural resources are going to be needed. And so you're going to have a demand for those natural resources, and you're also going to see probably those emerging markets that are highly dependent on the commodity prices doing well as well. I think the inflation that I lived through was one of supply push inflation, which is basically money printing for the sake of money printing with no productive capacity whatsoever. So, I think we have a little bit of both today, right? It could be said that not all the money in this stimulus package or all the money being used today is going to be used for productive reasons. You have a bunch of money printing at unprecedented levels, and then you have an actual plan to put that money to work, which will lead to likely other inflation issues like labor getting more costly. So I think it's one of those moments that I see from my third world perspective that inflation is hitting on all cylinders here. So it's interesting to see what inflation hedges are coming down the pike. Gold's always been there, right? It's been an interesting play, but it also has been interesting how it hasn't performed so well in the last few months, given the inflation narrative that we've seen. What do you think that is?
That's a great question, because you're right. We've seen the same thing. Gold is essentially flat this year after starting the year not doing very well, bottoming out, I want to say around the end of February, and then kind of making a little bit of a run, I want to say in April and starting in May. And I think how that is because of the inflation story and the inflation numbers being so much higher than it's expected. I think it was like 2.5% in March and then 4% in April. And these are way higher than expected, albeit off of a very low base from 2020, right? Like we saw some bleak numbers in 2020, but still with that, we think that has been a huge trigger for the run up in gold recently. And it also helped, we believe that it helped get over that 1800 optical hurdle in, I think was the beginning of May. And now all eyes are on 1900, and it's kind of been around there. And it just has to do with, I think, the optics and what people are expecting for inflation going forward. What we saw at the end of 2020 was COVID vaccine, recovery. 2021 isn't recovery, it's magnitude of recovery. And then when you talk inflation, it really changes people's expectations on that magnitude. And I think that has been a story that we've been coming across a lot lately when we've been talking to advisors about this and how they're going to position themselves. There was kind of jockeying for the right position, but based on this inflation and the magnitude of recovery, that's where they're not sure. And where we think that the gold and other physical assets have been there to kind of help dampen some of the equity market volatility we've seen around these numbers, and also parlay that into the growth that they've been seeing over the last couple of months in these physical assets.
I think there's definitely that inverse relationship gold has to real rates as well. And we saw that just even a couple of days ago when, the Fed sort of changed its position slightly and said, hey, we might be actually raising rates sooner than we thought. And you saw, I wouldn't call it a bloodbath, but certainly a check back in the gold price, just 3 days ago. So I do think there's that real rate, that inverse relationship with real rates that gold shares that definitely has some impact on a day-to-day basis. What about the deflationists, the David Rosenbergs of the world who are saying, hey, wait, the demographics, the growth, the debt, all, I don't know that the inflation is permanent. Maybe it's more transitory. What do you think of gold and in a deflationary environment? What are the proclivities of gold in those types of environments?
Well, we look at gold as, again, as a store of value and a very long-term investment and like a core allocation to a portfolio. So if we're talking about inflation and it's transitory, or 2 months of high inflation, then you have a lull for like 6 months or whatever the time period is, and then it either goes down or back up. We're not really trying to speculate on what or how much inflation is going to be. We just believe that inflation, I don't know, it's just like it's going to be there in some respects. And having a physical asset in the portfolio is just generally, we believe, is good just to capitalize on whatever that's going to be. I guess we're just not trying to time the inflation. That is what I'm really trying to get at. And to allocate to physical assets, just so you don't have to kind of make that determination on how much it's going to be.
It's so, I mean, you're treating it as more of an all-weather type holding.
And again, part of a core allocation to your broad equity portfolio, right? We're not saying to replace it by any means. We just like to use it as a, diversifying component and just to be present in that space in case inflation is whatever it is, because it has been so topical lately. And it's
typically investors don't view gold as, more than a tactical holding, right? I mean, it's actually, it's actually nice to hear, speaking of gold, but it's not just strictly something that you own at these tactical moments. So I think that's an important point to share with advisors and investors, is that gold should be treated as something more strategic rather than tactical.
And Joe, I don't know if you can, I'm sharing my screen right now just to give the audience an idea of this like long-term holding mindset that one has to have. Are you guys seeing my screen now or no?
Yep. It's up there.
And so on the bottom right here, you're going to see the gold price from the 1970s to today, along with, bonds at the top right, global equities in the top left, and commodities in the bottom left. And you can see that each one of these has a positive expectancy. You see it going from the bottom left to the top right over time. And each one of these asset classes has their day in the sun and has their day in the winter. And gold seems to be one of those asset classes that just tends to work and diversify at the right time when everything else isn't working, right? But it requires such a long-term mindset that I think it's pretty difficult for investors to really hold on to that stuff long-term. So wait, I'm kind of curious, just from your perspective, how do you help advisors get over that hurdle?
It's an interesting question. I just feel like with the access to information, there's so many articles written about so many things, and the behavioral finance of investing, and people make emotional and sometimes irrational decisions about their investments, that they may have more of a tactical approach, even though what they are trying to do is a strategic investment allocation. So we just think that behavioral finance has a lot to do with it. And with our product, we're trying to take that out because the fund actually does this for you. So we believe that gold and other physical assets are the long-term hold. You just have to commit to it and try. What we believe is to try not to let the behavioral or the knee-jerk reaction or what's the flavor of today really influence your long-term strategy. Set your plan and stick to it. And we believe that.
Yeah, we're very big proponents of that. I mean, I don't know if you have our target chart handy there, Rod, but I think that helps people sort of understand that you can have part of your portfolio that's tactical. There's nothing wrong with that. But at the end of the day, I would take some advice from Ray Dalio, where he says, if you don't own gold, you either don't understand economics or you don't understand history. And this is an asset class that has been around a long time and can be a very positive contributor to portfolios in different regimes. So in the market target chart, we call it, you have two dynamics. Horizontally, you have growth, and on the vertical axis, you have inflation. And they create four regimes: an inflationary regime, a disinflationary boom regime, a deflationary bust, and a stagflationary regime in the top left-hand corner. And when you have expectations around inflation and growth changing, the assets in these various quadrants respond quite predictably. If you have inflationary growth above inflation, the growth of the globally is okay and can offset the inflation in the underlying input costs. Those real assets do really, really well, gold included. Conversely, if you're in a deflationary bust or inflationary stagflation, your traditional assets like stocks and bonds don't do well. And they don't do well because there's a structural relationship. If you have inflation that's higher than expected, and the global growth is not able to overcome those input costs, profitability of both bonds and stocks is very low. And thus those forward cash, discounted cash flows are low. But what does do well are things like commodities and gold. In the 1970s, gold returned 24% real, while there was negative real returns in stocks and bonds. And that was for over a decade-long period. So, in our view, rather than trying to guess, you probably should have some strategic allocation to hard assets like gold in your portfolio. And then think about the second step is thinking about being tactical in that holding. But so we would agree wholeheartedly.
I would also note that gold is the top performer of three out of those four quadrants. It just seems, what I think what's happened is that inflationary and accelerating growth regime has dominated our careers for last 20 to 30 years, and therefore it feels like that is where you want to put most of your eggs in that basket. But the reality is that if you think about it long term and you think about these long cycles that Wade was talking about when it comes to real estate, it's the same thing for gold. But if you want to be prepared, you need to think about these hard assets, including gold, as a long-term strategic holding that might be able to protect your wealth over time.
In particular, in a period where we've, you look at, money supply growth, M1, M2, vis-a-vis, hard assets, when you create that much money out of thin air, certainly, gold, there's an extra 1% to 2% of gold created a year, but it's not 25% of the monetary supply as we've sort of globally done over the last little while. So we made a great case for gold, real assets.
I was just going to say, this is
yeah, go ahead.
I got triggered. Love it. I love it.
So wait, I just have because holding gold is a tough behavioral thing. I know there's a ton of options to get access to gold. And I do want to talk a little bit about why, you jump ship to do this business. Why? It seems like anybody wants to get gold, just go ahead and buy the most liquid iShares GLD that claims to have direct gold exposure. Why would you want to throw your hat in the ring in such what feels to be a pretty mature market?
We just believe that innovation was really lacking, particularly in this space. And being able to bring an institutional type strategy to everybody was so appealing and so new that I couldn't personally pass up this opportunity. And so I'm working with some really great people who created this vision and this strategy. And I just am excited to bring this type of strategy to everybody, not just people with a certain amount of money to invest or anything like that, or high net worth or institutions only. This should be for everybody. And that's why I did it. I love to see when investors get the best of what can be available. And again, this opportunity was just something I couldn't pass up.
Yeah. Let's dig into it. Tell us everything.
Okay. The strategy behind WGLD looks at the realized volatility through a 45-day look back period, the realized volatility of gold, and then also the realized volatility of the S&P 500, and then makes its allocation its gold allocation based on the algorithms that between the relationship of gold and the S&P 500. So because it has this adaptive exposure to gold, it really adds value to investors because they don't need to time the market of when to essentially buy or sell gold. The fund will actually, or the index will do it for the investor. And another huge benefit of that is that investors don't create a taxable capital event themselves. So they don't have to sell their ETF shares if, they think gold is going down. So we find that this is a huge benefit and something that just wasn't in the current marketplace.
So just to understand the timing aspect of it, are you talking about 45 days standard deviation and having a volatility cap, or are you allocating between gold and the S&P in terms of timing?
Nope. It's the only two assets in the portfolio are gold and cash. So it's either invested in physical gold or in cash. So there's a floor value of 50% gold, and then it goes up to 100%. We don't use leverage, derivatives, any futures or anything. Like there's none of that. It's just a matter of rotating between gold and cash based on the levels of realized volatility of gold and the realized volatility of the S&P 500.
I see. Okay. So you're just providing a vol size gold exposure that automatically reacts to market dynamics, reduces or increases gold. Fairly simple, no derivatives.
Right.
And that actually helps with the behavioral side of holding gold for the long term, I imagine.
Right. And we rebalance monthly. So it captures recent periods and then doesn't include, say, periods 2 years ago that just may not be relevant based on market data, just may not be relevant to currently what's going on.
And are you smoothing that at all, that 45 days? So you're observing at the end of every month, looking back 45 days. Is that you exponentially smooth that? You just simple moving average of the vol? What are the mechanics?
We simply just annualize it and that's it over the 45 days.
And then how does it interact with the clear part I get to gold? Here's the vol over the last number of days. The vol was twice as high, so we have a reduced exposure. How does the S&P's vol play into that? How does that algorithm weave itself into there? And then I've got a follow-up question to that.
Sure. It's a two-step process. So we first look at the gold volatility. So if it's below a certain value, then the allocation, let's say week launching the fund today, would be 100% gold. And if it was above a certain value, then the algorithm would begin reducing the exposure. And that's always going to be true. So again, if it's below the certain annualized volatility level, it's going to be 100% gold no matter what the S&P 500 is doing. But then once the gold volatility goes above its threshold value, then it looks at S&P. Hey, what's the S&P 500 doing? Is it volatile? Yes. Okay, well, let's increase some of the exposure that it just reduced because of the high gold vol. And if the S&P 500 volatility is low, then it would likely keep that reduction in volatility because gold volatility was elevated.
And is it the same 45-day sort of simple look back period that you're using on the S&P as well?
That is correct.
Neat. And so that would be the step one, gold vol, step two, S&P vol as it relates to gold vol, and then rebalance the portfolio for the upcoming month.
That's correct.
And then hold that. And so my follow-up question is, what's the theoretical linkage that you believe, or that Wilshire believes, brings that the relevance of the S&P vol into a gold positioning? What's the first principles thinking on that?
It's generally because when S&P 500 volatility is high, then we often see the rotation to value, whether, increasing US dollar or allocations to gold. So as like a safe haven. So we would want to increase our exposure during those times to capitalize on what we would expect as higher demand for gold and increased gold prices.
That's very interesting.
All right. And then, so what, I'm sure you probably have back tested this in some way. What were the levels of increased risk-adjusted returns? Is it mainly accruing on the risk side? Are you seeing enhancements of return and risk? Well, what are you seeing there on your portfolio stats?
Yeah, so we back tested this for the last 20 years, and we saw improvements on both. We saw improvements on return, and we saw improvements on risk-adjusted return, because the Wilshire Gold Index, which is the underlying index for WGLD, had experienced a lower level of volatility than gold. So it's a slight outperformance of gold through backtests and slight improvement in volatility. So both of them with essentially improved the risk-adjusted return.
And what about the portfolio contribution? So you are changing slightly the character of the return vector of gold. Did you look at that and look at the contribution to sort of the traditional 60-40 and how that was impacted?
I don't think we looked at that in the traditional 60-40, but we did look at it compared to the S&P 500, again, as an allocation to the core broad equity portfolio. And again, improvements across the board, better risk-adjusted returns and slightly higher returns, because you were still having an allocation to gold during crisis periods, during some downtrends that were maybe more sharp V formation, and again with a lower volatility, and often lower volatility than the S&P 500 itself. It just improved the overall function of the portfolio than just broad equities alone. So we thought this was really attractive, and again, through innovation that we just really haven't seen from in the gold space in quite some time, or yet at all.
I got one or two more follow-ups. Hold on, Rod. I know you're itching. The tracking error. So how is the tracking error? Because that's something we find too is often a challenge, right? Even though something might, in the long term, 20 years, add significant value, if it holds back the portfolio for 5 or 6 years, that's a really tough tracking error issue to address. Did you find any observations in the tracking error that were helpful, or hindrance, or some things you have to educate around?
I mean, tracking error is something that I don't believe doesn't get talked about enough. Unfortunately, it's really difficult for us to measure that, right? Because what we can do is we can extrapolate the fees through the Wilshire Gold Index and in the back test. But what does that really tell you? You backed fees out. I mean, there's other things that contribute to tracking error and how the fund is managed. And we launched this fund, I think 2, maybe 3 months ago. We just don't really have enough data yet to really see on whether whether the tracking is really an issue at this point.
Right. I was actually referring not to the tracking error to your own index, but more the tracking error so that if it's a 60-40 portfolio, for example, or if it's an all equity portfolio, what's the client experience like? And then what is it to just gold? So do you underperform gold at times where you're sort of sitting there? The advisor will come to you and say, "Hey, look, you're not keeping up with gold. I bought you for gold," which, probably want to own both, have some active and some strategic. But
right, we're gonna see some differences in the tracking to gold for sure, because it is some periods the index will be underexposed to gold, right? And other periods it will be 1-to-1. Like it never goes beyond 100%. So it's like that's the maximum. So either we're going to be perfectly correlated with gold, or we were going to be underexposed. But the algorithm is going to tell us what to do. So just over the long period, we just saw the outperformance, and it's ebbs and flows. Certain times we would outperform, and again, probably when gold was more volatile and likely trending downwards. And then there was other periods where the index did not perform well, And I think the most glaring period would be when the index, or there was significant volatility that suggested a reduction in gold exposure right before gold had a strong upward trend. And then we were underexposed in a rising gold market. But the end of that month, the index would rebalance and potentially recapture that gold exposure back up if gold was still continuing in that upward trend. So it ebbs and flows. But again, over the long term, we saw that it added some value to the portfolio and generally outperformed physical gold over the long period.
So Wade, I don't know if you've spoken to any Gen Zers in the last few months of your life, but some in that group might say that you're an old man, boomer, and that gold's out and there's a new kid in town called Bitcoin that is eating gold's lunch. I actually saw that perception of that, this divergence between inflation being a big thing, Bitcoin going through the roof to 65,000 while gold started going down. What would you say to that generation that believes that gold is dead?
We believe in crypto. We believe in, we have filed for a Bitcoin ETF ourselves, and we believe in the space. And what I would say to a Gen Z or anybody else who would think gold is dead is, we look at them as complementary assets. And because they have so many differences, like, let's step back for a second. We see the, GLD and IAU, they're both physical gold ETFs. They are direct competitors. They're essentially the same thing, but crypto and gold are different, right? Like, they're fine that they're both commodities, but one's digital, one's physical, one's like a payment method or a currency. The other is like a safe haven or a store of value. There's a lot of benefits to having both of these in the portfolio. And so we're just telling people who are saying gold is dead that they could both coexist for a variety of different reasons. And we think that they can both add value to your portfolio if used in the right way.
So is the idea, I imagine that if you're going to be getting exposure to Bitcoin, it's going to be in that type of risk managed way as well? Or is the concept there just getting that Bitcoin exposure and moving on?
Well, the Bitcoin story, it has been difficult because there hasn't really been a long period and a lot of economic cycles, inflationary cycles that can really tell us how Bitcoin behaves over the long run. And I say Bitcoin, but I really mean like general cryptocurrency, because Bitcoin is just one of thousands, right? And they are all different. Like, Bitcoin is mined and there's limited supply, but say Stellar Lumens is agreed upon transactions between the buying and selling party, and there's no mining or anything like that. Just as an example. And supply is a different story. So I generally want to stick to the general crypto story versus singling out Bitcoin. Because they're so different. Again, we see them as a complementary part of the portfolio.
Have you? I don't think you've launched that product. So are you entering into discussions with advisors and allocators, and how are those conversations going, or how are you helping them wrap their heads around the crypto space? And
it's difficult to talk about that one since that product hasn't launched. Yeah. And the SEC doesn't really give us a timeline for approval. And there's a lot of prognosticators who are estimating when this will happen. And I'm just not in the prediction. I'm not in the prediction space. So I'm just going to, I'll just leave it at that.
Well, I wasn't even looking for a prediction, but just that, you guys, as you said, you're not talking to advisors yet about it. So it's hard to speculate on how that's going to go, but more just general. Are you getting a lot of, since you launched, do you get inquiries, or are people calling in and saying, hey, when's this thing going to be live?
A lot. a lot of interest. And I think it's been great for us. And the other three partners here at the firm are crypto experts, and they know this space so well, and have been able to answer a lot of those questions about the space, about the product. And that's just kind of what we have to do right now, is just answer the questions. We're hearing the interest, and that's all we can really do right now.
Are you guys planning on launching or developing other ETFs or with other commodities that use a similar adaptive approach? Can you do that, or does it only apply to gold? Or
we plan on launching a number of ETFs with the adaptive approach, because we can use it on essentially virtually any asset class, sector, pretty much anything. And we think there's a lot of value in this adaptive exposure approach that just really hasn't been brought to the market. And we're excited for our pipeline. Like we're really, it's going to be great. So we plan on bringing it to probably stick with the commodity space to start, and then move into other asset classes with it.
As you consider other commodities, I mean, the one thing about gold that's interesting is it's relatively concentrated in its value. So it's also relatively easy to hold and store. Copper, for example, would be a much harder one to find warehouses if you were going to trade physical. Or how are you guys thinking about those issues?
Storability is not really an issue for gold. And it's great because it differs from energy products that are mainly futures based. Then they have rolling concerns with the futures, whereas just gold is spot and that's it. So I guess the only other concern with some of the other metals are degradation over time, and the oxidization of copper is quite high. And one of the benefits that we've seen with gold is that it's used in so many consumer electronics and medical applications because it's such a great conductor of energy. And it also has, it has a low oxidization and high retention. So, we preferred that over other commodities to start this business.
Yeah. And how are the ESG concerns with respect to that? How are you tackling the sort of wave of ESG awareness that's washing over, especially when it comes to, assets that are mined or drilled, or all the implications for the environment?
Yeah, we have started to have this conversation with advisors and other outlets. It's been a topic that it has come up a lot. And the ESG the situation with gold has a lot to do with the mining and fair wage inflation. And it's become such a big topic. And we see that as fair wages and ESG concerns around that are increasing, we see that the mining companies are likely going to have to compete on a fair wage and also an ecological fair footing. Like they're going to have to return mines and sites back to the condition that they were acquired in, or better, whatever the local governments want as part of the agreement to purchase the mine if they are out of country. And all of the legal and regulatory conversations and costs associated with all of this, we believe are going to increase the cost to mining gold and other physical assets. And because of this, we think that the price of gold and other physical assets will probably increase to a point where mining companies will sell their physical assets like gold and copper and other metals until they reach a certain profitability threshold, because they have all these increased costs associated with ESG. And because of that, we might see increased price pressure to recover these costs. And then also you may see some supply disruption, because if the mining cost is higher than whatever spot is, or the futures that they can sell it for, then the decreased supply could essentially also help increase the price of a lot of these physical assets. So you see ESG playing a huge role in commodity prices in general, in the near and long-term future.
So at a micro level, really cost push, price inflation on gold due to the rising input costs that are related to the environmental concerns, and actually having to price that into the price of a bar of gold. You can't leave the environment as an unaddressed cost. And if that's the case, you should expect higher cost of production for the actual commodity itself, which in and of itself should bode well for the price for those who are passive holders potentially.
Right. And we see this as an opportunity before this is really taken effect into commodity prices. I feel like this topic just has not been talked about enough, and we believe it's just getting started, and it's going to be something that investors are going to have to consider in the long term.
And in terms of new exploration, these concerns they're pretty high barrier to entry, right? I mean, there's definitely something prohibitive about it as well,
right? And you might see a reduction in miners because of it. Oh, the additional costs to entry, or to ones who are existing, increased continuing costs for continuing operations may increase and force them out of the market, reducing suppliers, essentially reducing supply. Again, further price expectations. We could see that as a result.
Yeah.
And consolidation.
Yeah.
Right.
Yeah, I can't imagine trying to get approval for a new gold mine at this moment in time. We would like to dig a big hole over here in this nice, beautiful green space. Okay.
And it's global. Like nations are very aware of this, and it's topical. And we can see this happening no matter where any company is purchasing a mine these days.
It just looks like it drives the price of gold even higher, but it also lends itself to, because of the difficulty in starting a new gold mine, that you could see where the attention might shift over to, crypto mining as an alternative to, to getting. I mean, that's also a minefield as well, with
or
power
brownfield developments too in the gold space, right?
Yeah.
So areas that are already have produced or in production resparked as prices rise, as happens in every cycle.
We saw this with Bitcoin, I think, a couple of years ago, where I think the cost to mine it was somewhere around $9,000 or $10,000. Bitcoin had dipped below, it was like somewhere around $6,000, and people were just storing their Bitcoin until the price got back up to somewhere above where they were mining it. And that was it. Because it's already has a maximum supply, the availability just drove the price right back up.
Yeah. And I think with the commodity space, given how ingrained it is and how many big companies own as many properties that have been exploited already, there will be an attempt to clean it up. But there's also the emerging liquidity in the carbon emissions credits that a lot of these companies will need to buy and use in order to become ESG friendly. Not to mention the fund companies that are dealing in that space as well. So there'll be creative ways of dealing with all of this in the future.
Bullish on carbon credits too. Look at that. I think carbon credits have outperformed Bitcoin, but anyway. Like, don't quote me on that. Not advice. Where can people find you and Phoenix Wilshire and learn about all the things that you guys are doing? Or Wilshire Phoenix, I'm sorry.
Yep. The Wilshire Phoenix website that's our corporate site, and our ETFs are listed on wshares.com, and WGLD is listed on the New York Stock Exchange. So it's available at virtually anywhere you can purchase a New York Stock Exchange listed product. It's been a great fund. We're really excited about our business and look forward to bringing more exciting innovation to investors really soon.
And anywhere on social media that folks can follow you and the firm?
Yep, we're on LinkedIn, Instagram, Twitter, Facebook. We're everywhere that people are.
Right on.
So Wade, this wouldn't be raise your average if we didn't ask you a final question. It's a would you rather question. Would you rather spend a week in the past or a week in the future? And why?
That's an interesting question. I think I would spend a week in the past to make the future better. Just to fix the things that maybe could have been fixed sooner, done better, done sooner for the benefit of other people.
Well said.
Interesting.
Here I was, the capitalist going all about me.
I was going to get that almanac book.
Just kidding.
But see,
the sports
That's great. Oh, Ray Sports Almanac. That's like one of the greatest. Yeah. That's like my favorite movie, by the way. Like, I'm even kidding. I could probably recite the entire script.
I recently rewatched it. It held up. You know what? Star Wars, rewatched it this weekend with my girls. It holds up. They're incredible.
It does.
Yeah,
Oh, great.
it's amazing.
That's great. My wife hasn't seen it yet, so there's an opportunity there. So.
Yeah. I found The Matrix too. The Matrix is coming out with a fourth Matrix 4, and the first 3 Matrix movies, they really stand out.
If I had to, I would go back in time and stop them from making 2 and 3 for The Matrix and number 4 that's coming up. I think the first one was the only one that was worth watching.
The first
that's what I would do with my time machine. Pierre, you didn't ask, but there you go.
No, I would. No, I would go back and stop him.
Yeah. But so wait.
I kind of agree with Rodrigo because I would, especially when they ended The Matrix with "Wake Up" by Rage Against the Machine. I was like, that's the end for me. This is amazing.
Last scene 100 times.
And it's the only movie I'd watch like credits just because it's playing Wake Up.
100%. It's amazing. The whole soundtrack for that first movie is amazing. Yeah.
Amazing.
All right. Well, thanks, Wade. Appreciate your time.
Thank you so much.
Thank you for having us on. Thank you. It's amazing.
Yeah. Pleasure.